Good morning. I'm Julian. I'm the Managing Director of Deterra Royalties. We're a royalty investment company that's listed on ASX. We have some interesting assets based here in Australia, and in particular, we can provide exposure to iron ore in perhaps a way that other companies can't.
Well, good afternoon to you. Good morning in my case. Thanks for coming on the show. We've not met or spoken before, so I'm really keen to understand the setup there. I say a non-precious metal royalty company is a rare thing indeed. But I tell you what, Julian, if you don't mind, can you sort of kick off, give us a bit of your background?
Yeah, sure, absolutely. So I've been here at Deterra since we were formed about 18 months ago. My background is in the finance space, and prior to working here at Deterra, I'd worked for Iluka Resources, which is our parent company from which we were spun out, really with a focus at Iluka in strategy and business planning. And prior to that, I'd worked primarily in the M&A space in corporate roles and initially in some project finance opportunities in the United States.
Okay, fantastic. And why the spin out? Yeah, that's a bit sort of intrigued me about this initially.
Yeah, sure, absolutely. So, yeah, as you know, we were spun out from Iluka about 18 months ago. We were spun out really as a collection of royalty assets and a business with a mandate to build a broader business. But essentially, our story is one that's probably not that uncommon in the sector. Iluka had over time collected accumulated a collection of royalty assets that were non-core to them, that weren't really. Iluka is a mineral sands operator, and they had some royalties that they'd collected really through legacy activities over time. And I think there was a recognition that there was an opportunity to spin the business out as a pure play vehicle in the space, and really give investors a very clear line of sight to the assets that were involved, as well as establish a company that was going to be able to build on the foundation of those assets.
Right. So if I just focus on the management team just for a little bit longer, I get this of
Sure.
where the royalties have come from, but in terms of your ability or the team's ability to identify like future royalty opportunities, I mean, what's the royalty transaction experience in the team?
So we have as you'd understand in the space, we're fairly typical in having a relatively small team. Obviously, we have no operations. We're taking financial interests, and we really have two main focuses of the team, and one is about stewardship of the assets. So there's all the activity that goes along with being a listed entity, but the area where we're spending most of our time and is really the area of focus is in that growth space. So as you say, it's about identifying these opportunities, evaluating them, and then acting on them as appropriate. So the core skill set we've really brought into the team is really around in that business development, as we call it. So the identification of opportunities and the evaluation of opportunities. So we have a team that has sort of a strong technical base, as you'd expect, whether they be in the trained geologists or mining engineers or the like, that are really able to take a very clear view on where we see value in some of these opportunities.
Right. So, we'll get onto the kind of profile of the assets, the type of assets that you'd be diligencing in a second. But what's the kind of split between that DD internal versus external? I mean, what is the size of the team?
So we have 8 people in the team at the moment, and I think that one of the important skills is to be able to do a certain level of diligence ourselves. So typically we set the team up so that we can evaluate opportunities at a desktop level fairly effectively internally. As we get further into that diligence exercise, we do look to leverage external expertise. So we'll be looking to get external experts help us with particular opportunities. And as you'd appreciate, that's really a function of the size of the team and a desire to keep our corporate overheads at as low a level as we can. When we have a fairly broad investment mandate, both in terms of commodities and geographies, as you'd expect, it's not efficient to maintain a deep level of expertise in every one of those possible opportunities that we might see at some point in the future. So, we're structured so that we can leverage that external expertise as we need to.
Okay, and so how many deals have you done since because obviously Iluka kind of rolled, spun out. You spun out of Iluka. You had some assets there. Have you done any new transactions since that point?
No, so we've been, we were spun out about 18 months ago. We've been very active at looking at opportunities, and we've seen some interesting opportunities that we've taken to a fairly advanced level. We've been participating in sort of pursuing those opportunities. We haven't executed on anything to date in that inorganic space, and that's really just a function of finding the right opportunity at the right price that's going to deliver value for our shareholders.
At the right price, yeah.
Exactly.
Okay,
but I don't think it's controversial to say that certainly where markets are at the moment, value is a little harder to find than perhaps it has been at other times. So, it's really important to us that we maintain our discipline and really ensure that when we do invest, we're going to do so in a way that's going to add value. And so,
looking at your M&A background versus obviously the diligence required on royalties, do you find that is there a difference? Do you find that there's a slightly different art in terms of doing diligence for royalties versus just maybe an M&A transaction?
Yeah, certainly. And on a number of different levels. So, at one level, when we think about the pipelines of opportunities we see there, clearly, we talk about primary markets and secondary markets. So primary markets is really where we're looking at writing new instruments. And in those cases, we are very much acting as a source of funds. And so what's in a way that's more akin to a project finance type approach. But what's really critical in that case, as you'd expect, is really understanding the nature of the project and the deposit in particular. And then there's a secondary space where we're looking at where there are existing royalties that maybe are coming to market. There's a fairly active market in trading existing royalties. That perhaps is a little more akin to an M&A type opportunity. But to be clear, for both of them, when you think about what really drives value in a royalty or a stream, it's about understanding the deposit. What's the prospectivity of that deposit for extension or expansion? Because as a royalty holder, effectively, you participate in that at no cost. So that technical knowledge is really critical in terms of understanding what's in the ground, because at the end of the day, that's what's going to drive value.
So if we look at what's going on in the market at the moment, obviously, people have been talking about inflation for about the last 12 months or so, supply disruptions for the last 18 months. You've got commodity prices going through the roof. You've got maybe not so much in the case of royalties, but definitely in terms of equities for mining companies, there's been a divergence between commodity price and share price. How has that changed the nature of the kind of normally formulaic approach to evaluating an asset and whether you go in there? Has that hindered you in terms of getting deals across the line? Was people's expectations because commodity prices expected to continue to rise? Why has it been hard to get a deal over the line in the last 18 months?
Yeah, I think perhaps just to sort of address the comment about sort of the nature of inflation and how that's impacting on our view of opportunities. I think it's a really important point that you make. And when we're looking at participating with a royalty, generally you're sitting quite a bit higher up that P&L statement. So, particularly if you're looking at a revenue-based royalty, your returns are really driven by volume and pricing. You don't have that same exposure to operating margins. So, it's really important to understand that we can offer a qualitatively different exposure to mining operations than you get through investing directly through straight equity in an operator, where you do have that operating margin does drive returns. Not only that, but also capex requirements, all the rest, all these other ways, calls on cash. We don't have that issue. So that drives a different perspective as well in terms of from a due diligence perspective as well, because we're much more focused on what's driving that top line perhaps than what's driving the bottom line. To come back to your question really about the impact of commodity pricing and how that's playing out in where we see value in opportunities. Look, there's no question that higher commodity prices can sometimes drive higher expectations in terms of the vendor of these opportunities. As a royalty holder, typically we're looking to take a long-term view of value. So we'll be looking at how, our view on how pricing is likely to behave over the life of the mine, as opposed to being driven by where spot prices might be right now.
Okay, so
look, sorry.
Yeah, so it's like a typical royalty company. You kind of immune to some of those cost impacts, but there's a kind of not volatility, maybe it's the wrong word. But I'm just looking at your share price over the last 18 months, and there are waves. So what are the things in the market that actually, and you're in a good run at the moment, so it's all since October last year, it's all good. But there are waves in terms of the way the market affects your share price. So therefore, some people would be forgiven for thinking, well, this is just a dividend play, right? So how can you affect sort of sustained, whether it be slow accretive growth or not, and stop these sort of dips that occasionally hit the market?
Yeah, so I mean, certainly, with our current portfolio, we are, our major asset is driven by iron ore pricing and production out of the Pilbara. So, it's not unexpected to see our share price, responding to movements in iron ore pricing, and particularly sort of expectation. It's a multi-decade asset, so it's about expectations about how prices are going to behave over that multi-decade life. Not having that operating margin exposure, there's probably less direct leverage to price than you see in some of the operators. But certainly, we also have within our portfolio, we have some substantial organic growth as well. So we are seeing, and particularly since sort of mid last year, we've seen strong growth in volumes from our core asset as well. Through there's an expansion currently underway, and that's driving organic growth. In terms of sort of the business model as well, and our objective, certainly, we are, as I mentioned, very actively looking for opportunities to add to the portfolio. But as I said, we will be very patient and disciplined about how we go about doing that. We do have strong cash flow. We do have organic growth. We don't need to go out and make investments simply to deliver growth or cash flow. We'll make sure we're focused on value.
Right. Okay. And so the reason I asked that question is in the context of, like, you've got a significant institutional following here, and they usually are a little bit more conservative in terms of trading in and out. So you should expect them to keep the share price a little bit more consistent and solid than they are. I mean, what do you put it down to? It can't just be the commodity price. People are trading in and out of this. What would you say to shareholders and say in terms of delivering that kind of consistent, sustained revenue stream and your expectation of their behaviour?
So we certainly, as I said, we offer the exposure, and the way the portfolio is at the moment, we're offering exposure to primarily the Pilbara iron ore production, but it's qualitatively different from what you can get with exposure through an operator. And to the extent that investors at times will be looking for that greater operating leverage, and at times they'll be looking for less of that. And I think that certainly we offer less operating leverage. We offer insulation from that operating margin. So I think that certainly that's a factor. I think that we have a history of paying out dividends. So to date we've paid out 100% of our net profit after tax, and that's fully franked for our investors that can use those franking credits. So we certainly are focused on providing our investors with a cash flow return, as well as exposure to the price. Right,
and that's sort of circa 5% or slightly above 5%. So that's well above a sort of typical royalty company dividend. So that's good news. Before we move on to the portfolio itself, I just want to talk about the strategy, sticking with what's in the minds of the management team, yourself. We've seen a little bit of M&A activity in the marketplace. I think most recently we saw the acquisition of Nomad Royalty and the Base Core portfolio by Sandstorm, and $1.1 billion, and that kind of was a new addition to the conversation for Sandstorm, and it was obviously a big chunk of change compared to their market cap, etc. Is that part of your potential strategy going forward, or are you focusing people on your multi-decade current assets and and that kind of organic growth? I mean, what are the options on the table for you?
Yeah, so certainly, as you say, we've seen a bit of consolidation over the past 12 months in the sector, and I think those options are always there for everybody. I think in terms of where our focus really is, it's on finding really high quality operations and deposits that we can put in, we can get an interest in through a royalty or a stream, and what's probably more important for us is the quality of that underlying asset than precisely how we get that exposure, whether it be through primary, secondary, or sort of an M&A driven opportunity. We're focused on finding good quality opportunities.
Right. Okay. Custodians of your cash. Let's get on to the portfolio then. So if you don't mind, because there's not that many of them, what's the overall portfolio size? What are the ones that we should be looking at in terms of being materially advanced?
Sure. So we have 6 royalties currently in the portfolio. 3 of them are producing. One is a royalty we hold over iron ore operation in the Pilbara, and I'll come back to that in a moment. And we have a couple of other producing ones which are over mineral sands operations in the southwest of Australia here. By far and away the most important asset is that Mining Area C royalty. It generates more than 99% of our revenue. So to give you a sense of scale, in the 9 months to March this year, it's generated about $150 million of revenue for us. Those are Australian dollars, clearly. So it's a strong cash flow generating asset. Mining Area C is one of BHP's sort of core hubs in the Pilbara iron ore operation. As I mentioned earlier, it's currently undergoing expansion through the opening up of the south flank of the South Flank mine, and following which, BHP has said they expect it to get to a capacity of about 145 million tonnes a year. Just to put that in context, BHP is currently producing about 290 million tonnes of iron ore, so effectively what we're looking at here is a royalty revenue that we hold of 1.232% of FOB revenue over what would be, all else being equal, about half of BHP's total iron ore production. Mining Area C, once the South Flank expansion is complete, will be the largest iron ore hub in the world.
Okay, that's number 1, clearly.
Yeah. Okay. So as I said, that generates more than sort of 99% of our revenue.
Yeah.
So we have 2 other much smaller assets that generate. They generate sort of in the hundreds of thousands of dollars a year in revenue. They are mineral sands operations. They are coming towards the end of their operational life, but both are looking at potential expansions or extensions rather of their operations. But very good to have the assets in the portfolio. They give us additional cash flow, but at present, certainly the key asset is that Mining Area C royalty. Right.
Okay. But let's talk about the potential there, because otherwise this is you don't want it to become a one-trick pony. You're not setting this up just to because of BHP. So with the 2 which are kind of maybe looking to extend life of mine, would that just be more of the same, or would that be a significant contribution from them, or an increased contribution from them? What's that look like going forward?
Look, I would imagine it would be similar. So we're not looking at substantial growth from those. We have a couple of other assets that are not producing. The nature of royalties is you never quite know if or when they will come into production often. But look, in terms of the portfolio going forward, certainly, as you say, I think we are very focused on building out that portfolio and introducing other sources of earnings and other sources of growth. And that's really where that additional business development investment comes in. That we have organic growth through MAC, but the future growth will really be driven by us bringing new assets into the portfolio. Right.
So of the 3 non-producing current assets that you've got in the portfolio, do they have JORC reports, or I think just for North American audience, like the equivalent of 43101s on them? How advanced are they? I guess is what I'm asking.
Yeah, no, I think that sort of too early stage for that level. So, as I said, they are options in the sense that you never quite know what's going to happen, but certainly, they are not, we don't see them as being huge drivers of value at this point.
And in the short to medium term. Okay.
In the short term.
Right.
Absolutely.
Okay. So that's, and are they, all of these are within public companies, I should say, are they?
Yes. So yeah.
Okay, so we can sort of understand, and I couldn't. So, is there a list of those three companies? Sorry, those three non-producing assets. Who are they with?
So there's a. So certainly we provide the details on our website and in our sort of public materials. So essentially they're with sort of three well-known mineral sands operators.
All right, obviously because I look at being the. Okay, that makes sense. Okay, so I guess the importance of actually let's go to finances, and we'll come back to new biz and development in a second. So you give back 100% of net profit to your shareholders, and obviously that's very highly leveraged to the price of iron ore at the moment, which I think things are good at the moment. What have you kind of given guidance as to what you think the market's going to be doing in terms of iron ore prices going forward?
No, look, I mean, everybody has their own view on where where iron ore prices are likely to head. We provide, as you say, exposure to that, as well as exposure to the production and sales volumes coming out of mining area C.
Right. Okay. So can we just spend a little bit of time in terms of the organic growth? You've said that it's you've looked at lots of stuff, but it's kind of hard to get over the line. You don't want to overpay. No one does. I assume the strategy would be to stick with non-precious, of which it's what I think you put in your PowerPoints, like 29% of public royalty companies are non-precious. So. Does that mean that the competition is less, or that other companies are prepared to pay more than you, or actually there's not a lot of optionality out there in terms of assets that are of a meaningful size for you to bid on? I mean, what are things holding you back on the organic?
So I think that as you say, the precious space certainly has more players. There are more opportunities, but there's more people chasing those opportunities. We feel that outside of precious, there are fewer people pursuing those opportunities, albeit it's a slightly smaller set, but the ratio is a little more favourable. I think that and that shifts as well. That there are a number of companies who are purely precious focused. There are some who are looking for primarily precious focus, but will still look at opportunities outside of precious. So it's always a little bit of a moving target in terms of who's active in the space at any time. But certainly from our perspective, we recognise that we certainly have a strong basis in bulks in iron ore, so it makes sense to build off that. So our focus is on other bulks, on some of the battery metals, and certainly on some of the base metals, where we think that there is perhaps a significant number of opportunities. There's a significant sort of capital requirement coming up to be invested to deliver supply into some of the forecast growth that we're hearing about in some of these metals, which is a good opportunity for companies like us.
Yeah, I was going to ask about the. Would you be sticking with bulks, or are there some of these battery metal royalty companies coming out, which seem to be, not a lot of competition, but a heck of a lot of interest, and with commodity prices moving, they might become attractive even if it wasn't in a bulk context, or are you going to just stick with bulk?
No, we'd certainly move out. We'd certainly look at base and battery metals. I think we when we think about those opportunities, as I said, there's probably a few key criteria that we look at, and one which is as we spoke about was really about understanding of the deposit and the geology and what the prospectivity of an operation was for longevity and expansion. The other also is, we need to be conscious that the interest we're taking in these when we invest is different to if we were an operator. So we're not operating the mine, so we need to get comfortable with the operator. We're not, we want to know that the commodity itself has good solid fundamentals, as you'd expect it. Everybody wants to be sure that the supply-demand fundamentals are solid, and also that there's a relatively mature and transparent end market for the commodity, so that we have a clear basis for establishing how we get paid. How that royalty will be determined.
Right, and given your knowledge, I've got to ask this question with regards to coal, met coal specifically. A lot of producers are throwing off a lot of cash. They're making good margins at the moment. Is that a kind of no-no in the royalty space at the moment? I think we've got a royalty company in the UK which does have exposure to that. But would you be allowed to, if you wanted to, look at the met coal market?
We've certainly, I think, we've been quite clear from day one that we wouldn't be pursuing coal opportunities. That's a combination of through ESG concerns and just concerns about how that might be reflected in how people view us as an investment, as well as, frankly, longer term value concerns as well. And take the point that there's cash being generated at the moment, but as I said, we look to take a longer term view on, we're anticipating a long term exposure to the assets as well. So
right, okay. And with regards to jurisdictional exposure, what's your view?
So look, we're obviously based here in Australia. That's our backyard, so it's a natural area of focus for us. We also think that it's an area that perhaps has been not as well served by royalty and streaming financing as other parts of the world. So that's a natural area of focus for us. But we do have a broader mandate as well. We certainly look at opportunities globally. Our strong preference is for well-established mining jurisdictions. So in particular, North America, South America, Europe are quite are areas of interest for us. And so we certainly have and will continue to look at opportunities outside of Australia.
Right, and just so coming back to my comment earlier with regards to obviously the importance of BHP, but and the fact that it made 99% of the revenue coming from a single asset risk. We have seen instances around the world where big operations have come into difficulties. Is there an urgency for you if you feel that the organic growth could be there, but for whatever reason something goes wrong, that you need to get a deal done quicker? And if you can't get a deal done in terms of acquisition, finding a project that works for you, would you consider M&A in terms of taking over other royalty companies, just going to de-risk that single risk exposure or single jurisdiction exposure?
Yeah, I think we look at it not as we certainly don't feel that there's an urgency around the need to sort of introduce other assets into the portfolio. We see it as an opportunity. We see MAC as it's a world-class asset, and we see it as a great foundation to build upon. So we're certainly looking to do that. I think that your question about would we look at M&A opportunities? Well, certainly we would. I think we would look at, as I mentioned earlier, a whole range of ways to identify those opportunities, whether that's writing new instruments, whether it's buying existing instruments, or whether it's actually through the M&A field. So we'd certainly be looking across all three of those. As I said, at the end of the day, the decision will always come down to how well does the asset sit within the portfolio? Is it going to generate value? That'll be our focus.
Right. Okay. So how do I know it's predominantly institutional share register for you guys, but if for retail or family offices looking at this thing, is this just a good solid dividend paying story, or do you think that you can actually start moving the dial when it comes to the share price as well? Yeah,
so we're certainly, as we sit at the moment, as you point out, we do have a good solid dividend payment history, and that was part of the rationale for the creation of the company, was to give our shareholders clear line of sight to the cash that was being generated by the mining area C royalty. But the other side of the business model is exactly as you said. It's to generate growth as well, to build upon that, and in doing so, we'd certainly hope that we can deliver additional value to shareholders.
Right, and for now, Iluka's holding on to their position? They don't need cash, do they?
They retain 20% on demerger, and that's so they're our major shareholder at present. Yes.
Brilliant. Okay. Well, Julian, I appreciate the run through. I guess actually one last question is right. Compared, you said that you're different from other royalty companies. So, in that sense, why are you a better bet than some of the other royalty companies out there?
Well, we're different in a number of ways, and we've I think touched on all of them. And we're different in our we're based here in Australia, so we provide royalty exposure through ASX, which is not it's a new investment opportunity for investors on ASX. We're different in the sense that we provide that exposure to bulks in a way that perhaps there aren't other opportunities that people can invest in bulks through royalties at scale. And we're different as well in that we are, we do pay out a strong dividend. We have a history of paying out 100% of net profit after tax, which again, I think is quite an important point of differentiation with some of the other players in the space.
Right. Okay. And do you think at the moment that the multiples that royalty companies are attracting are fair and reasonable? Because there's such a difference. Our analysis, certainly some of the North American precious metals, and maybe that doesn't apply to you, but do you feel it's a kind of fair reality of the investment return expected for some of these companies?
I think, as you say, there's a number of factors that go into that, whether that's the commodity exposure that's provided, the level of leverage they provide, the sort of the nature of portfolios, the history of the individual companies themselves. I think they're all factors that go into how the market is going to view a business. Certainly, from our perspective, we're very focused on taking good care of the assets we have, helping the market understand the value of those assets, and look to continue to add to it to grow a broader business on what we think is a really solid foundation.
I guess one advantage for you is that you've got a few moving parts. I mean, compared to some of these royalty companies with 120 different assets, retail, family office, and quite frankly, brokers struggle to make the time to work out whether it is a sort of fair and reasonable multiple that are being applied to all of the assets. You don't necessarily have that problem. So in some ways, a nice, simple proposition. Well, look, Julian, thank you very much for your time today. It's great to hear this story. Really interesting what you're laying out there. And we hope to see you again soon. Thank you.
Great. Thank you very much. I appreciate the opportunity.